Good afternoon, everyone. My name is Diego Portillo Mazan. I'm the director of the Inner City Capital Connections program, and it is my pleasure to welcome you to this afternoon's conversation. Before we get started, just a couple of housekeeping rules. I'm going to ask you to go ahead and rename yourself, full name, and the name of your organization. This will make the networking and the conversation a little bit easier for everyone around. Uh, I will also ask you to go ahead and mute yourself during the first part of this presentation. There will be opportunities to come off mute and have conversation with the panelists in a little bit. In the meanwhile, if you have questions as for the presenters or for the ICCC team as we go along, please drop them into the chat box and I will make sure to read them out to the moderator or answer them in the chat box. So with that, I will turn it over to our CEO, Steve Grossman.
Diego, thank you so much. Diego, as many of you know, is the director of our Inner City Capital Connections program. We're joined today by Marini Ponce, who's the deputy director. And I want to express particular gratitude to Anna Marie Cruz, ICCC's Western Regional Manager, and Naomi Bekele, who have been so involved and instrumental in recruiting this wonderful group of healthcare businesses and entrepreneurs for this capital panel. I want to give you just a bit of background about how this all happened. ICIC has a number of urban business initiatives, and in those initiatives, particularly the Inner City Capital Connections program, we admit businesses from every conceivable industry, and generally in a cohort there are 12 or 13 or 14 different industries represented. But a group of us got together about a year and a half ago from Kaiser Permanente, which is one of our major sponsors. They sponsor a dozen Inner City Capital Connections cohorts all over the country, and Amerisource Bergen, whose foundation sponsors as a national sustaining partner cohorts all over the country, most notably in their hometown of Philadelphia. And we got together and said, let's do a pilot. Let's do an experiment. Let's recruit a cohort that is defined by the cluster in which it does business. And we looked at the various clusters we could have recruited from and determined very quickly that Kaiser in the healthcare business, Amerisource Bergen in the health and wellness business, that healthcare made the most sense. So we recruited an inaugural cohort within a cohort for Atlanta last year, very successful. Some of you were from that cluster. We reached out to other healthcare businesses from our alumni, from various other programs, and we've got a wonderful group of companies, all of which share something in common. In one way or another, you're in the healthcare or wellness industry or business, and having that in common makes an enormous difference. We find that when businesses come together in clusters, they tend to grow faster, they share best practices, they cross-fertilize, and many of the concerns they have around capital, job creation, leadership, marketing are ones that they share in common. So thanks to Kaiser, thanks to Amerisource Bergen and its foundation for the idea and for the partnership that we've enjoyed for many years now. And it's now my pleasure for some opening remarks to introduce my friend and our colleague, Lamont Robinson, who's Director of Supplier Diversity at Amerisource Bergen. Lamont is a supplier diversity veteran. There's no other way to put it. Grew up in Chicago, went to high school in Philadelphia, came back to Illinois for college, lives in Houston for the past 13 years, and he has played a leadership role in supplier diversity for large organizations, including Cardinal Health, VHA, Novation, Provista, and he's had much recognition, including 2010 Corus Boyd Leadership and Diversity Award from the Federation of American Hospitals. And I always like to cite a fun fact before I introduce someone. So the fun fact that you want to know about Lamont Robinson is that he authored his autobiography in 2014, which is entitled Transform National, Journey of a Bastard, close quote. Journey of a Bastard, close quote. Which details his personal experiences in overcoming challenges on Chicago's violent West Side to achieve success. So it is now my pleasure to introduce our partner and our colleague, the Director of Supplier Diversity from Amerisource Bergen, Lamont Robinson. Lamont, take it away.
Thank you, Steve. Again, it's always a challenge getting introduced by you because I don't know if I could ever live up to your introductions. They are factual, but just the way you make it sound, it just sounds fantastic. But we are honored first of all, the Amerisource Bergen Foundation as well as Amerisource Bergen Corporation. Honored to be a part of this event. Honored to be partners of ICCC. I joined the Amerisource Bergen Foundation Corporation in February of this year to oversee our supplier diversity efforts. And just like Steve stated, I've been in supplier diversity, specifically in healthcare, for a long time. I clearly understand the healthcare supply chain. And for those of you that don't understand who Amerisource Bergen is, we distribute pharmaceuticals. I mean, to be as simplistic as possible. And so when you think about the events that happened in 2020, one of the things that really it highlighted was really a limited access to healthcare for those in underserved communities. And so when you think about the efforts of ICCC and the need to be able to support businesses that are supporting those underserved communities, it's extremely important for not only the organization, but personally myself to be a part of an event like this. I'm excited. I'm excited to get the chance to be able to meet many of you. I'm excited to be able to moderate the panel that I'll be a part of. But more importantly, I'm excited to hear from you. And I'm excited to be able to hear what's going on in the innovation that's being brought together as a result of healthcare innovation, especially when it comes to diversity. As all of you know, diverse businesses are the engine of innovation. And so having a chance to be able to combine that innovation into the healthcare community, where again, I stated access to healthcare has been limited, and the emphasis on health equity is something that not only this organization, ICCC, is focused on, but also for Amerisource Bergen, the corporation and foundation. So again, I'm thrilled to be here. I'm excited. And again, thank you, Steve, and the ICCC organization. And I look forward to the rest of the event. So thank you.
Thank you, Lamont. It is great. I think one of the things Lamont talked about is the diversity in the companies, but it's also incredible to see the diversity in all the areas of the healthcare industries that the businesses represented here today are. And one of the things that we talked about and heard from you, the business owners, is as important as the education that you may have heard from the panels at the opening seminar about the capital landscape overall, it gets very detailed and very finite and very complicated when you're talking about an industry as diverse and as complicated as healthcare. So today we're happy and honored to have so many practitioners who not only work in capital, but specifically in capital with experience in this industry. So the way this is going to work is over the next few minutes, I'm going to ask our panelists to spend about 5 minutes sharing their work and their approach to creating or making capital available. And then Lamont is going to lead the question and answer period of this panel. And so without any further ado, I am going to turn the mic over to Aurelia Alvarez, who currently serves as the Director of Business Development for Founders First Capital Partners, an impact lender committed to fund and scale small businesses led by diverse and inclusive founders. As an angel investor, Aurelia is extensively involved in San Diego's startup ecosystem by serving as a connector and mentor to entrepreneurs, and was recently appointed to the board of directors at Startup San Diego. And with that, Aurelia, I'm going to turn it over to you to introduce your organization and sort of some of your thoughts on capital in this particular space.
Hi, good morning. I'm Diego, and good morning, everyone. It's a delight to be here. Perfect, right there. So I'm here on behalf of our amazing team, Founders First Capital Partners. Capital Partners is located in San Diego, California, but we do invest in small businesses all across the country. Founders First Capital Partners, it is the largest private capital provider of revenue-based financing, specifically for small businesses that are led by diverse and inclusive business owners. Next slide, please. So without even going into the different options that are available out there as far as for small businesses, our specialty is being a provider of revenue-based financing. I'll refer to this as RBF just to be more brief. So you might be wondering, oh my gosh, Aurelia, what is RBF? So pretty much RBF, it is a loan. It's a very creative loan that's been structured because it really takes the best of both worlds of your more traditional bank debt, as well as the more traditional venture capital. So it is a hybrid of both business models. To put it in simple words, how does it actually work? So the way that it works is that a business or a small business pledges a percentage of their future ongoing revenues in exchange for the capital that they're receiving. If you do look at the RBF landscape, the types of checks that are usually provided could be as small as 100K, and they could be up to, I would say, north of $5 million in annual revenue. But whoever is the provider of RBF, given that RBF providers tend to be more focused on the impact that they're creating with their capital, they definitely analyze your financials ahead of time to ensure that the RBF instrument never becomes a burden on your financials. As far as like the RBF landscape, usually how much of a check could you potentially be looking at? It really depends on the provider, but it's usually 3%, or not 3%, I'm sorry, 3x of whatever your monthly revenues tend to be. And then it's really nice because there's so much flexibility with revenue-based financing. For example, you never pay a fixed amount or even a fixed amount on the loan itself. It really fluctuates based on your monthly performance. So let's say if you do an amazing job one month of bringing in like 50K in monthly revenues, you would only pay a very small percentage. It's usually no more than 5%. And for whatever worst case scenario, next month you only generate like $5,000 in monthly revenue, you would only get charged, again, a very small percentage of that. It's usually never more than 5%. So it really, again, it's really based on your business performance month over month. And then next slide, please. And just to give you, the next one, right there, perfect. And then as far as like what, with the different alternatives that are available for small businesses, in our opinion, and of course I'm going to sound biased because we are a provider of revenue-based financing, but it's a very I would say instrument that's focused on the founder. The interest of the founders always placed before that of the investors or even the lender. But if you are looking at this instrument, like what are the positives? Number one, even though there is a component of VC integrated into this instrument, you still never lose equity. There's no equity that's given up by the founder. There's no stake taken in the company, not even a board seat. So if you're the type of founder that wants to maintain as much financial control of your company, this would be a fantastic option to consider. This is where a lot of the innovation really happens. For a lot of the small business owners, especially the market that we do serve, because they are diverse and inclusive business owners, they don't necessarily have many assets perhaps to pledge. So we never look at we never ask for like any really significant collateral to be pledged, like personal, whether that means your home or any other asset. We don't look at the founder's personal credit score. It's more focused on what is your business traction, who are your customer base, and what's the potential of this business moving forward. So it really focuses more on the business model. Then next slide here. And so I'll share a very brief story or a case study of one of the most successful RBF stories that we've recently had. So this is an amazing founder. She is an engineer by trade. Valerie King is actually based out of Chicago. She has this amazing company. Even though she had an amazing track record as far as having huge contracts, amazing traction, customer base, phenomenal technology, it was still very difficult for her to access any type of capital that was out there. Even from impact investors, they were still not considering her company. So the nice thing with our organization that we were able to kind of jump in here is we look at the business. We saw, okay, what is the potential if this company were injected with a check from us? What does that really look like for this business moving forward? And we did address some type of like financial health in there in a matter of a very short period of time. And as a result of going through that 30-day journey, we were able to invest in her a $250,000, which is a big deal, especially for a small business. But the most important thing here is that because we are considered an institutional investor, she was able to leverage our investment and actually even syndicate that deal because she was able to bring in more investors as well. And as a result of receiving this investment, she's hired on more folks into her team. She's increased her marketing, and she's definitely increased her pipeline as well. And then the last slide here, this is just an example of the different healthcare companies that we work with in the last couple of months, just to give you an idea. So they vary in region, different capacity, different offering, different services, but everyone's in the healthcare industry. Thank you.
Thank you, Aurelia. And we will have plenty of questions for you. I've started to see a couple already that came in directly, so I will save those for you. The next panelist up will be Hadi Jallo Coulibaly. Sorry. Hadi is Vice President of Credit at Now Corporation, a partner of ours throughout the country. Hadi joined the Now team pretty much at its founding and has built the credit and operations team from the ground up. As Vice President of Credit, she leads a talented team of risk and operations professionals dedicated to helping small and mid-sized businesses grow fearlessly. Prior to joining Now, she was a senior underwriter and credit analyst at F-Trans Corp, and she is also the founder and CEO of Elevate Foundation, Inc., a nonprofit organization that helps provide educational, health, and financial resources to children and related benefits to mothers in underserved communities in the US and abroad. And with that, I'll turn it over to you, Hadi.
Thank you, Diego. Thanks for having me. And it's such a pleasure to be back on with you guys again. But not in person, but still on Zoom. I miss being there in person with you guys. So thanks for having it. And I hope everyone is well and safe. And thanks. I am Hadi Coulibaly, VP of Credit at Now Account. So just a brief history and intro on what Now Account is. At Now Account, we are committed to empowering businesses to grow fearlessly through accelerating invoice payments. What that means is we don't want you to stop your growth. We want you to focus on what's important to you, which is your business, and we'll help accelerate your invoices for cash flow that you need. And quickly, just to explain how Now Account started, it's an invoice payment solution that redefines how businesses get paid. We are in Atlanta, but our clients are across the United States. It was started by serial entrepreneurs who felt the pain of waiting on payments from larger customers. Our founders, Laura Hodgson and Stacey Abrams, had a baby bottling company that they were selling to big retailers like Home Depot and Whole Foods, where they had big orders, and then they were excited about that. They delivered and were waiting for payment and got another big order, started celebrating, but realized they were not paid for the first one and didn't have the money to fund the second one. And they're like, wait a minute, you didn't pay us, but you're asking for more, so where's our money? Having that problem is what prompted them to start Now Account. So there goes the vision, which is to create a world where diverse businesses of all sizes have access to capital, commerce, and customer opportunities. Sorry, oh, never mind. So how does Now Account work? We allow you to get paid immediately on your invoices while your customers are taking the flexibility to pay later. Has anyone ever told you that you can actually reduce your days of sales outstanding from, let's say, 30, 60 to like 4 days or even less? Well, that's what Now Account does for you. So it works in very simple steps, 4 steps, as you can see at the bottom. The first is you do what you do best, deliver your goods or services to your customer and invoice them. Our system allows you to choose the actual account that you want to put on our service to accelerate payments for that account. So then you will give us the invoices for that customer. You get paid within a day. Imagine that, instead of waiting for 60 days. And what else do? You just wait for the next order, or you jump on the next order and continue to manage your business while we wait and we collect on those accounts and manage the risk for you. There are great benefits to businesses being on Now Account, and we have a few here listed, and I'll share them with you. So it gives you access to capital with early payment. This is capital, this is cash that is yours. Having it on your books and not having access to it is not helping your business grow. So Now Account unlocks that for you to help your business grow. It also gives you the cash flow needed, again, to take on those large customers and contracts that require longer payments. That also helps show the capacity for some of you in the healthcare industry that have government contracts or need to bid on government contracts. This capacity actually shows the government that you have it, the funds or the line of credit with someone like Now Account that allows you to fulfill orders to come instead of being cash strapped. We are a non-recourse product. That means you also have reduced risk of exposure to your customers. We take on the risk of non-payment. What that means is when we buy the invoices from you, we're buying the invoices from you in a true sale. And when we take it, we insure those accounts. So we take on the risk of non-payment. What we ask is you give us accounts that are free of any claims, meaning you've delivered, you've done your job, and they're not going to be disputed. As long as that happens, we take on that risk of non-payment. It is receivables financing. It shortens your days of sales. The pricing is very transparent. Is flat. We don't charge you depending on when your customer pays. The fee is flat when you come on based on the terms that you offer your customers. So the fee ranges from 2.5% to 5% based on terms, 30 days, 45, 60 days, or 90 days that you offer. So based on that, we would advance you 100% of your invoice, net the fee, and wait for your customer to pay. Gives you the ease and lets you sleep at night knowing that you have the cash to carry on to the next business opportunity. So again, you choose the customers that you want to put on Now Account. What we ask is you keep that account on and those invoices coming. It's lower risk and it's easy to manage on both sides. It wouldn't be an accounting nightmare for you. We have a very quick enrollment process that we have on our website. Easy to go in and put in a few information. It takes a matter of minutes to submit that. We don't score the owners or principals of the business. This is strictly related to the business. We score the business. We don't take personal guarantees. We may screen your customers because we have to make sure that they're credit worthy. But other than that, no financial information on the principals are attached to it. So it's a very easy and flexible program for you. Just to add to that step, who's a good fit for the business? A simple requirement, the business must sell to other businesses or government. No consumer trading, it's just strictly business to business or business to government. You must have a qualifying SBFE score, which is the Small Business Financial Exchange score that is powering the scores that we get from either Equifax or DMB. Most businesses don't realize that they have a business score starting off, but we educate our business owners. If you come in, you don't have a qualifying score, you do have an opportunity to work on the credit and then come back later. We tend to not want to turn away people and not educate you as to why. So that opportunity is there. We look for federal tax liens, public records, basically. Of course, no one wants federal tax liens. We don't want to be behind the federal government and be collecting after us, but that's one thing. So we check all the records to look for those before you're able to fully qualify for a Now Account. In terms of the invoices you submit to Now Account for payment, the invoices have to have terms. Again, our fees are based on terms, not the days it's going to take for your customer to pay. So customer can have net 30 terms and take 45 days to pay. We don't charge you extra for those 15 days. We understand that checks could be cut under 30 and get mailed out and we get a few days later. So again, we take that risk for you. You don't have to worry about that. The invoice cannot be past due when we purchase it. And then the invoice must be for completed work or service. We don't do purchase order financing, but at least if you start with us, remember you get the cash flow needed to continue to fulfill other orders to come. The one challenge, and I'm pretty sure most of you on this call would understand that, is that we cannot buy or fund an Medicaid or Medicare billing because of the insurance aspect of it and the non-guarantee of how much we will get back on payment. But other than that, if it's a non-Medicaid billing that most of our clients that are in the industry have, we are buying those and funding them. And lastly, just to share a few use cases, and I pulled out a few of our clients, 3 of our clients that are actually in the healthcare industry and have pretty different products, but just to talk about them real quick and just to share with you guys how people have used Now Account to help grow their business. First is Idtech Molecular Laboratories. They're a direct service provider who builds medical facilities, primarily for lab tests. Now, this company, I thank people in the medical industry every day for saving us, because without these facilities, we wouldn't really be as comfortable as we are today. Idtech is one that came to us right after the pandemic, and they were running these lab tests for people, the rapid tests that they're still doing. And of course, as you would know, their business was growing, and we were able to get them approved. We were able to increase their capacity so they can acquire some contracts and do the testings. And because this industry is booming and also people are taking forever to be able to process the billings, they were able to avoid waiting for 60, 90 days to get their funds and being able to buy the supplies that they need to continue doing their work while we work on collecting their invoices. So that challenge to them, we alleviated instead of having to worry about where the next set of funding is going to come from for them to continue business. Libra Realty is a procurement company that procures pharmaceutical and medical supplies, mainly now for CDC. They also did it for HUD a while back, but they had a huge contract. This is one account that we actually wrote a credit confirmation letter for them so that they can have this contract of millions of dollars and show that we have a revolving approval in-house where they can purchase the supplies that CDC will need without interrupting business for them or CDC. So it was a huge success and story for them because they've been on their account since 2013 and are still using us. CDC has been a client of theirs and a customer in our system since then. And we continue to help them, and we have grown with them over time. And Oasis Surgical Assistance is the last one that provides surgical medical staffing needs to WellStar. This was an eye-opener for me because I didn't even think you could provide staffing for that specific field. But they also, staffing has been a challenge because obviously the people you place to work will not be waiting for you to give them their paycheck 30 days later. So after they have the staff work, they have to run payroll. After that, that's what they submit their invoices for, so we can fund that payroll that's needed for work that has already been given to their customers and have the staff continue to work and grow the staff and go to different facilities. So there are different ways that our clients use this. These are just specific to the healthcare industry, but our industry, our market reach is wide. We don't have a specific industry. That's why our products is very simple and can be used for anyone, but I'm pretty sure, considering the industry, that this is much needed, and we'll be happy to answer any questions. And I know my colleague Earl is on here, would help with Diego if questions come on as to how to onboard to join our team. Thank you.
Thank you, Hattie. I'm going to pass the mic over to Shane Kelly, founding partner at Wolverine Angels, and probably the greatest bio that you have probably seen. I'm only going to tell you a little bit about it, but Shane believes that technology and content inspire the imagination, and imagination will inspire a more equitable economy. So he's not only invested in tech in California and backed founders in California, such as Rachel Payne of FEM, Joel Eiffel of Dash, and more. And as a film finance executive in New York, helped realize visionary pictures such as Robert Altman's Prairie Home Companion and John Turturro's Romance and Cigarettes. In total, Shane has invested in over 20 tech startups and participated in financing over 20 feature films. and has also immersed himself in the application of artificial intelligence to mitigate human bias in venture investment decision maker and iterative startup strategy. So there is plenty more, and we will share those, but Shane, it's an incredible bio. I'd love to hear more about some of these ideas, particularly around angel investing.
Thanks so much, Diego. So I am going to take a little bit of a step back. If you could hold off for a moment there on the video, and then we'll get started on that in a moment. But I wanted to give a little bit of a step back and a little bit of perspective here. Really appreciate the kind words. And my background has been in operating startups. I was in a company in the entertainment industry that raised $60 million, and I was one of the first employees there. And we raised equity, but we also raised debt, and we were banking our receivables, right, along the lines of what Hattie is and now is doing, right, in terms of financing receivables. And so I was doing that as an operator, as on the entrepreneurial side, and setting up facilities of $10 to $20 million to finance entertainment. And then since I moved over to venture capital, I've really been focused on a range of things, but more on the equity side, right? I think what you're hearing so far in this presentation is mostly around debt products, right? And I've always been more of an equity investor. So I'm sure you all know, but it's kind of equities at the bottom of the stack, right? So debt holders get paid first. They're in first position, lower risk, and presumably lower returns, right? So it's a more affordable kind of capital that you can, so I tend to encourage entrepreneurs I talk to go talk to the founders first of the world and the nows of the world to really see if those capital opportunities are available, because those are really extraordinary opportunities, because you can go raise capital and retain control of your company, right? I think we have this notion in venture capital that, the end goal here is to raise $100 million and have a $1 billion valuation, but that doesn't help you solve your customers' problems necessarily, right? Like you're not in business to raise money, right? You're in business because you want to solve a core problem. And so that is something that I always look for in my founders and my portfolio companies, is someone who can really inspire and move the world in a positive direction. And so my background in that, my first venture capital fund investment was almost 10 years ago in a company called Pneumatics. So it's a very strangely spelled thing. It's Neumodx. This company was doing rapid PCR testing technology, and they were acquired by Qiagen for $248 million, right? That's like one of those really rapid trajectories. This is the founder's third startup, and he's had a lot of success in that space. And so I was very fortunate for that to be one of my early investments in venture capital. And then moving forward, I've invested in specifically healthcare companies, also in straight just technology companies. But a couple companies just to touch on as well. I think the one I want to jump to is that video. Actually, it's a company called Neurable, and I met the CEO of Neurable in, I think, 2015, and we invested at that time. Now, Ramses, the CEO, he's a first generation Mexican American, and he tells the story of his uncle who was in a trucking accident, and he lost the use of his body, of most of his body. And he kind of on that moment committed his life to solving that problem for everyone, And so their whole thesis is a world without limitations, right? from that perspective. What they wanted to do was provide humans with the ability to navigate the world despite any physical disabilities they may have, right? What they ended up realizing is they needed a lot of capital to do that, and that this technology was broadly applicable. And so they ended up raising capital. We were in the first capital that went into the company, and ended up raising capital in order to build the technology in a way that's accessible to all, right? Not just to people who are disabled, not specifically just to the healthcare industry, but they have done work in the healthcare industry and in other industries, but it's fundamentally a core technology that's pretty inspiring. And so I don't think we'll have sound, which is, I think is better without, but you'll see just an example. Basically what the technology is, a brain-computer interfaces. So what that means is that with a simple set of headphones, the company can develop correlations between your brain activity and your intent. So I've actually done it. I've tried it. It actually works. It's crazy. But they can understand when you're focused, when you're not focused. They can understand if you're using your phone, if you want to skip to the next song or skip back to the previous. And what they've done is they've gotten this from 26 sensors in a gel cap, in a lab in University of Michigan back in 2013 to this set of headphones that you see here today. And the idea here is that if they can get enough data using these headphones to correlate and understand when people are focused, when they're not, and they'll be able to allow people to control any device with their thoughts. And I've actually literally played a game just with my thoughts with their technology. It was pretty amazing. But you can imagine the applications of this to support, folks in the healthcare industry. And they're deep in those conversations and already have engagements there. But I just wanted to share a little bit about the kinds of companies that I tend to invest in, which are, this Indiegogo campaign launched just 2 days ago, right? It's, you can buy these headphones for $200-300 pre-buy, and they'll come in a year or so. And this is the kind of thing that I tend to invest in companies that are really building the future that we really want to inhabit, and can inspire and provide increased access. Now, this is a company that needs equity, right? Because they have actually raised several $1 million. They need a huge war chest of capital to develop the technology and get it to the point where it can be broadly accessible to everyone, right? And so that's really where I come in. Is I have run funds, and I run an angel syndicate for University of Michigan alumni called Wolverine Angels. And what we do is I try to encourage folks, raise as much debt and alternative investments, alternatives to equity as you can, so that when you raise equity, you can be very specific and deliberate to partner with folks that can really help you get to your goals. And that is not when you raise, but if you raise equity, right? Because a lot of equity investors are looking for that rapid growth, high risk, big exit. And, I think most of us very often would just as well have a very solid, stable, profitable company that they can hand down intergenerationally, right? And so I think those are the kind of companies that we really want to, I really want to counter the narrative that venture capital is the only way to go to build a really successful, impactful company. And moreover, that we love to invest alongside the Nows and the Founders First and the CDC Small Business Finances of the world, right? So thanks so much for having me, Diego.
Thanks, Shane. And we're going to go straight over to Stacy Sanchez, judge extraordinaire at our kind of gentler Shark Tank at the national conference last year. But in her real job, she is the senior community loan officer and healthcare capital specialist with CDC Small Business Finance. The latest news, of course, being that CDC Small Business Finance and Capital Impact Partners announced their alliance in March this year. So we see the nation's leading mission-based small business lender and one of the nation's leading community development financial institutions coming together. Stacy specializes in loans under $250,000 for new and existing businesses and/or business acquisitions in California, Arizona, and Nevada. And Stacy has been supporting small businesses in a variety of functions for several decades and helping and received numerous awards for it. So Stacy, I'll turn it over to you.
Thank you. Thank you so much for that introduction. Thank you. And let's go to the first slide if we could. So I'm with CDC Small Business Finance, and as he just mentioned, we've just merged with or aligned with Capital Impact Partners. So it's only been a couple weeks, so it's early in our alliance to announce everything that we're doing, but CDC is a certified development company. CDC's in the news lately, and we're not the Center for Disease Control. We are a certified development company certified by the Small Business Administration. A CDFI, or a Community Development Financial Institution, is certified by the United States Department of Treasury. So we're both organizations that are private, nonprofit, mission-based, just with different products and focuses. And so we're really looking forward to having a big impact. We've already started, even though I specialize in loans in California, Arizona, and Nevada, because that's CDC's limits. We've started already piloting some place-based loans to try to bring our mission-based products to different areas. We're doing some loans in Detroit and in Washington, D.C., and then some targeted loans in the Los Angeles area, just trying to get a feel for different needs based on a specific community. But today I'm here to talk specifically about our home healthcare loan product. And one of the points I really want you to come away with is that not all lenders are the same. I do a lot of SBA loans, or CDC, Small Business Finance, is an SBA lender. And I hear a lot from people that they don't think they can get an SBA loan, or they've been declined by an SBA loan, by SBA, when in fact it would have been just the bank that may have declined them, or just a specific lender who wasn't able to assist them. So be aware that not all lenders are alike. And you hear that already from my earlier presenters. It's the credit box, or that company's internal credit policy, that will determine that lender's appetite for risk. And you might need to chat with a few lenders to determine what's the best fit for you based on what your needs are and what your credit profile is, what you might have to offer. So we've just launched our home healthcare capital loan program. And this is a targeted product, a new way of looking at loans for CDC based on an industry, as opposed to what we've typically had our salespeople that are regionally based. So we are targeting non-medical and medical home healthcare businesses, hospice care industries in California, Arizona, and Nevada, in a loan range of $20,000 to $250,000. These are loans that are offered for working capital or operating expenses, improvements to the facility, equipment. They can be used to buy an existing ongoing operation, or if you're an existing business, it can be used to finance maybe debt that you used to get your business to its current stage. Our rates are typically about 1% to 2% higher than a financial institution. So right now, while we can go up to prime plus 6, we are typically in the 6.5 to 7.75 range, whereas a financial institution might be in the 5.5 to 6% range, just to kind of give you an idea. I think right now there's sort of a misconception about super low rates for small businesses because they're looking at some of the emergency loans that are related to COVID. So these loans are specific to small businesses at any stage in their growth and are not emergency loans or disaster type loans. So 6.5 to 7 3/4 is very competitive, typically over a 6 to 10 year term. One of the things that makes our home health care loan different is, these are just a couple of the 5 C's of credit, just to point out that we look at a loan in the same areas that a bank might look at it, but with maybe a little bit more flexibility or a lot more flexibility depending on certain areas. But the home health care loan, what makes it different is the back office and the salespeople have made a point of learning about the industry so that when someone's contacting us, we can speak intelligently about their industry and some of the restrictions that might be a problem as a result of trying to get a license, or issues that are trends that are going on in the industry. And that's not just on the sales end, it's on the back end, in the underwriting and processing departments. So everybody knows the industry more so than we would in some of the other loans we do, where you have to really be a generalist. So I just wanted to give you an example of a loan that we did. And I think this is a really great example of the types of businesses that are out there in the home healthcare and home healthcare medical. Just to clarify what that is these are nurses or professionals in the industry, typically bachelor's and master's degrees, more than 10 plus years experience, that are forming businesses that can be operated fairly low cost, typically an admin office, and they hire other professionals or other various levels of professionals to go out and administer services to individuals in their homes. This individual had, as you can see, she was an RN. She had 10 years in the experience and had worked as a case manager. She has a great job now with a large healthcare provider, and basically formed a business with the expectation that she will get work from her existing employer on a contract basis to provide her home healthcare medical services, as that healthcare provider leans more towards this service for their clients. But this one came to me from one of SBA's resource partners, SCORE, the Service Corps of Retired Executives. Strong credit, 689, not, stellar, but good. Had some lates. I just bring that up because nobody's really expected to have perfect credit. SBA requires that you take a lien on all business assets, but this borrower did not own real estate. And then we determined the business's ability to pay based on her business plan and her projections, which was an opportunity for her to show her expertise in the industry and really explain how she's going to make money. She came in with 20% of the total project amount. We provided 80% financing, primarily for working capital and some equipment. And it was with this loan and our approval that she was able to continue with the certifications needed in order for her to finalize her ability to open. So we worked with her for quite some time to provide the verification that she needed to get the certifications and be able to launch her business. I think this is a really good example. There are a lot of lenders like CDC across the nation that are providing alternatives to bank funds for just this type of business, where we recognize the level of experience that somebody might have and the commitment to their industry, which demonstrates their ability to be a successful business person.
Great, thank you, Stacy. I'm going to turn it over to Lamont Robinson again to moderate our panel for the next 20 or so minutes, 25 minutes, and then we'll go to a shorter networking session then. I think, Stacy, I think the first question I got personally was for you about expanding your footprint, or are there other CDCs across the country that are doing the same kind of product that you just spoke about?
You bet. So the loan program that we operate under that allows us as a non-bank lender to make SBA loans is called Community Advantage. And there are roughly 160 lenders across the country that are making Community Advantage loans. I can't speak to their individual credit boxes, but they are alternative lenders like us. CDC right now is in California, Arizona, and Nevada. We're testing some markets in Detroit and DC. And, you know, as it's only been 2 weeks since our merger to be a national organization, but our hope is that we will expand our footprint as we continue to develop these products.
Lamont?
Appreciate it. First off, I mean, great information. I mean, how do you follow up from that? So I'm just going to quickly get into it. And you know, some of these questions are questions that we thought about before, but some of them are just kind of off the cuff based on what I'm hearing. So I'm going to ask Hattie first. What risks are there for businesses that depend on contracts or vendors to meet their cash flow? As a small business owner myself, I understand some of those risks, but can you just explain some of that?
Yeah, I think it's a huge risk because, well, our founder likes to say, you know, cash is king, but flow is queen. We laugh at that when she says that, but it's very important since if you depend on your contracts to come or your vendors, you don't know what their cash position is. So you don't know when you are going to get paid. You will do your work, but it's okay. I'll just sit back and wait and see when that's going to come. What's that going to do to your business? You wouldn't grow. It could die. So the continuity could go away, and this continuity and the capacity and the ability to grow and stay in business is one of the key things that I'm pretty sure everyone here on the panel looks at before they actually advance or lend or invest. So if you don't have that because you don't have foresight, you don't have access to capital or the capacity to acquire or continue growing, then that's a high risk. So depending on just vendors to say that they will pay, you have to have that magic, you know, 8-ball to say that these people are going to be with me for the rest of the life of my company.
Yeah, I can imagine. You know, this one is going to go to Shane. So first of all, again, you know, I agree. Great story, great background. You know, why should most businesses not consider equity to be an end goal?
Well, I mean, equity as an end goal is just, I always encourage entrepreneurs, right? Why did you start this business? Most of the time, there's an easier way to make money than to start your own company that's going to grow into this massive thing, right? And usually it's about that motivation and that inspiration. And most entrepreneurs I talk to, they didn't start a business because they wanted to go raise money, right? They found a problem out in the world that they wanted to solve. And, you know, my friend Gary, who runs Worksite Labs, you know, he just saw a problem that needed to be solved. He said, there's not enough COVID testing facilities out there. I've been in this field for decades. Let me go outfit, you know, a little trailer, right? With all the mobile testing lab equipment that you would need and a tech that I can plug into a lamppost at the airport. And he grew that business in 6 months to 7 figures in revenue. He saw a problem that needed to be solved, right? And now he has 10 locations up and down California up and down the West Coast in the last, you know, 6 months. That is that he didn't set out to raise money, right? He set out to solve that problem, to help people get access to testing, right? And that needs to be your goal. And there are a lot of different providers. We as investors, we like to center ourselves at the center of the story a lot of times, right? Like, hey, this company is doing well because they raised all this money. No, we're service providers, right? We're here to help you. The entrepreneurs are at the center of this ecosystem, and we all need to just kind of gather around, lock elbows, and find ways to support their vision and their dream and where they're going.
I love that. And so hopefully I'm pronouncing, is it Aurelia? Okay, so Aurelia. So, obviously in the funding conundrum, which we've been talking about a little bit here, how does a small business grow if they don't have access to capital?
Can you hear me? Yeah, okay. Hi.
We can hear you.
That's a really good question. I was mentioning with to earlier colleagues this morning, I was like, this is exactly the question that I wake up to every single morning. And our team, we talk about this every day, right? So it's always an ongoing dialogue. But I would say the top three things when a small business owner is considering it's when they're asking, how do I really grow my business if I don't even have the capital to even start building out my infrastructure or adding more team members? Like, how do I even prepare myself? Number one, I would say definitely reverse engineer your success. Like really start off on that side. And then secondly, start small. And then thirdly, explore and really understand like the different alternative capital options that are out there. And I'll touch on all three of those. So for example, when I mention reverse engineer your success, it's a very painful journey, but you have to be very honest with yourself as a business owner, as a CEO, and as a leader, and say, what does my business financial health really look like? Let's say, for example, if you are really going after those larger enterprise clients or those bigger contracts, be honest with yourself and ask yourself, can I actually flow costs if I'm awarded those type of contracts? If the answer is no, that's time for you to really take the time aside and really explore what can I do in my financials? How can I improve my margins? What does my business model look like, right? And I share that because as you had seen earlier, when I shared that amazing success story of Valerie King, before she came to us, she had so many opportunities, but not necessarily securing those larger contracts, larger enterprise clients, simply because the financial health wasn't there. So I think this is very, very important. Again, like really do that deep analysis. And then secondly, when I say start small, when you are looking for capital options, it doesn't have to be a huge 6 or even 7-figure check. It could be something as small as like 50K. Or in this case with Valerie, it was 250K. The fact that she was able to say, look, I got this check from Founders First for 250K really solidify her business case to other potential investors. And then it's interesting because other investors actually started coming in to that syndicated deal, right? So it really opens source. Again, you can start small. And then thirdly, just really understand what are your capital alternatives. For example, if I'm a small business and I'm doing less than $500,000, I'm not necessarily going to be looking to get invested by those bigger VCs or other more equity-based financiers. Like really understand, what does my business model look like and who finds my business model attractive? Those are the type of investors that you should be really focused on. So I think if you can get those three down, that's really when you start opening yourself to more business opportunities. And that's really where that capital starts flowing by itself naturally without you just chasing those dollars.
Appreciate that. Stacy, I was not going to forget about you. So what trends or opportunities do you see in healthcare for small business owners?
Thanks. Well, I think we all recognize, the aging demographic of the United States, and you can't turn on anything that you don't see somebody commenting about that. So for us and our home healthcare capital loan product, we're seeing that tie in right with the trends that are going on with what's happening in healthcare, and that the public is aging and there's more need for services for that aging public. And we see more and more healthcare turn towards reducing costs. And one of those is aging in place, or staying in your home longer. And some of these healthcare and home healthcare services lend to that trend, allowing people to age in place and stay in home. We see more and more of the big healthcare companies supporting this trend, trying to reduce costs, keep people in their homes, and they're using small businesses to try to help accomplish these goals. So we just think it all goes together.
Appreciate that. So this one again is an off the cuff, and it was based on just what I've been hearing. So when you think back, and this is for all on the panel, so please feel free to speak up, but when you think back of the events that happened over the last 18 months, just how have those events impacted your specific areas of focus?
So I can take that first, just quickly. We don't particularly have area of focus in terms of industry. So because we have a wide range of clients and that are in several types of businesses, but just looking at our space of payments and funding, risk was on high alert everywhere you look. I think from a financial services perspective, everyone was on pins and needles and not knowing what happens. We also use a financial service, a trade credit insurance company to help us manage our risk on the invoices that we purchase. So you can imagine their world of preparing for the economies around the world to tighten or some just keep going down, country risk going up. So it's been really difficult from our side on some accounts to get people, because so our clients could be in the United States, but their customers could be anywhere in the world. And therefore the risk could be huge if you're in certain countries. And we've seen that tighten in the past 18 months or so. Let's just say about 12 months exactly, because it really hit April when they started sending out messages on credit risk. Collections have tightened, cash flow has tightened for a lot of businesses. If you look back, a lot of small businesses that started right before COVID may not be in business anymore. Some of them have pivoted and changed their business, which is also a risk when it comes to the trade credit finance companies, because you don't know what it is that they're offering as a product. Some are just doing it temporarily, and that's also a risk for some, because again, if they're relying on vendors and contractors to pay, you don't know if those people would be in business. So as much as we are in the non-recourse business, we also, the layer of insurance that we get on top of that had been a very tough market. Either way, I think we can pride ourselves to say that most of our clients that were with us before and that came on with us during the COVID, the pandemic from March of last year to now are still in business. And we were able to help them manage their receivables and get paid, because some of those that didn't get paid, we were able to take the risk. There was one that had a company file bankruptcy, and we protect companies from that too when their customers file bankruptcy and they delivered product. So there's a lot of benefits to what we offer, but it's also very high risk. And we've managed to handle it very well with the partners that we work with. But that's kind of what I've seen in the past few months.
That was
Anyone else?
Yeah, that was great. And that covered a lot of it. There is a lot of risk. The one thing I will add is that the term essential and non-essential became sort of now is commonplace, in that we look at businesses based on, our willingness to do loans, risk projections in a non-essential versus an essential business are completely different. Healthcare is considered essential. And that means that if there's something else that happens, they're not likely to get shut down, or capacity restrictions that could impact their ability to earn revenue like a non-essential business would be. So that's definitely a factor. And I think that's something that we'll see long-term considered.
I'll just briefly add really quickly, just because with Founders First, we do take a very unique and different approach when it comes to funding. We are very much big on education as well. So for us, during this pandemic, we actually saw an increase in the demand of our funding. So for us, anyone that wants to get funded, they have to go through like either a 30 or 60-day education program, because it's an opportunity for their business to understand the current marketplace and see how can they actually tap into those opportunities. So we did a lot of that, really fine-tuning business model. We did a lot of helping a lot of those companies pivot before we were even writing checks to them. So I think that was it's a very interesting, very different dynamic. Hence the reason that you saw that slide with so many healthcare companies in there, like that was in a matter of like less than 6 months that we worked with that many companies.
Shane.
I mean, it's been interesting for me the last, and I think for all of us, probably the last 18 months, and I appreciate that question. I mean, one thing that I had been doing prior was working with a data science company that was using technology to mitigate bias in the venture capital process. So how do you use technology to figure out where your own biases are and where the other biases are in the room? So how do entrepreneurs think about this company? How do investors think about this company? Men, women, all these different permutations, right? And so we were doing that for 2 years. I was doing that for 2 years, running a fund there from 2017 to 2019. And now it feels like, the one piece that I think has emerged is that we now have broader set of language, thanks to the uprising that happened last summer, to talk about inclusion, to talk about belonging, to talk about diversity in a new way. And I really have appreciated that, because one thing that I've seen is I'm seeing more opportunities going to underserved communities, right? Like the folks in this room are very often serving those communities already, right? And what I want to do is really figure out, how do we bring equity, debt, hybrid instruments, all the things together to support those entrepreneurs and those communities, especially those that have been, marginalized for so long. I think the second piece I would say that I've seen over the last 18 months is, when I was working for that fund, I was in LA and the fund was up in San Francisco. I was working remotely. I was on Zoom every day, like for hours. And so this was old hat to me. So I was very bullish on this idea of remote work and distributed work, right? And so I was looking at investments in the space. I was mentoring in places that had, a focus on remote work technologies. And then when the pandemic hit, it was everyone needed that, right? So it felt like that is another shift that I've seen of like, so delightful to see that access is being more equally distributed in that respect also, right? Where folks who have to be at home, or folks who are not geographically located near the job that they want, may still have access to it, right? And so I think those are some of the changes that I've seen that have transpired.
Lamont,
Appreciate it.
this is Diego. Actually, the last question came from the audience for you, and it's a variant of the question you asked Stacy. Is you, as one of the supplier diversity people at a very large organization in healthcare, what trends are you seeing that support small businesses in this space?
For me, I've been excited to see more organizations putting their funds behind their words. And so you're starting to see more incubators. I love that, because the incubators, the thing that I love about incubators is that they're very specific to opportunities. Because it's one thing about providing education, it's great to have education, but that small business owner at the end of the day wants to say, okay, what does this mean in terms of me doing business with you? And so for incubators, the beautiful thing about it is that it allows that education, while at the same time, from a funding perspective, it gives you a chance as an organization like ours to be able to look at what is it that you're looking to buy over the next few years, and then help to grow these businesses so that they could support not only you, but also similar organizations as well. So I think the thing I keep telling people is that I love about supplier diversity is that it's not about competition. So I don't want the diverse businesses that are working with us to only do business with us. I've been on many of those calls where something happened and we had to end the relationship, and you had those business owners that are saying, you were 90% of our business and now we've got to let go people. I don't want those calls. So what you try to do is just try to spread that out. And in fact, if you use your foundation to create these incubators, you have to spread it out. I mean, just it can't be something that's just for your usage.
I'm going to take that opportunity to plug in the fact that we do have another panel again, on the healthcare industry next week, same day, same time. And this one will be dealing with more of the procurement side of the house, because as Lamont just mentioned, contracts is the other part of this equation for so many of you. I want to thank the entire panel and for your time, your willingness to work with us. I know plenty of the business owners are going to want to be in touch with you or after this, so we will be sharing the decks and the information with all the participants after this. We are going to transition to a short period of networking. So I do want to, I will turn the mic over to my colleague Anna Marie Cruz to introduce that. But before we go, one last reminder for all the alumni in the room, we are just starting the program year for 2021. We will be having cohorts in over 20 cities across the country this year, and our first ever Canada program as well. So plenty of opportunities to either participate again, if that's what fits in your business, or at very least invite another business to take advantage of the program. And with that, I'll turn it over to Anna Marie Cruz.
Thank you, Diego. And thank you again to our incredible panelists and our moderator. We are now going to have an opportunity for some networking and some additional discussions around what we have talked about today. So you will actually be assigned to a room with a couple of our panelists, and we'll have about 15 minutes of conversation. And from there, we'll reconvene back into this room. Feel free to share information about your business, yourself, perhaps a challenge that you'd like some expert advice on from our panelists, and enjoy. And I'll turn it over to Naomi to assign the rooms.
I'll be sending everyone over right now. Gina? Oh no. You're all sent. If you should see at the bottom right of your screen, there should be a notification to say join rooms.